Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Investigating the correlation of returns and commodities on a monthly basis is not good enough. How can you improve this exercise? You actually did very similar analysis in your tutorial already, so many times. If the portfolio is going to be measured over 3 years of time, you should measure the inflation and the returns over that period as well. I'll leave this for you to do after class. You have all of the data needed. Australian equity bond returns and commodity returns and the inflation time series data as well, especially from tutorial 7. So you have all of the time series data you need to run a similar analysis. Hopefully, I'm going to have a look at a few. Some of you may include this in your assignment. So the problem with any quantitative analysis, make sure when you have a clearly defined context, you have to consider the data choice. Measurement interval, sample period selection should be aligned with your investors' objectives and investment horizons. So to advise a client like the one in your assignment, this evidence is not good enough. But for general purpose, we have looked at the general understanding of the correlation between commodity and equity. That's enough. The reason that the reversal of correlation between commodity and equity, and also the correlation between commodity and inflation, are going mainly driven by the financialization of commodity market in the past 20 years. Oh, I have exceeded the time limit. So the workshop has started right now. The financialization of commodity market, especially in Australia, happened during the second half of 1990s. So before the second half of 1990s, there was underinvestment in commodity market around the world. If you go to have a look at the capital investment of BHP and a lot of the Anglo-American, that's one of the other largest, probably one of the largest commodity mining companies, there was underinvestment in commodity in mining. But suddenly, in the second half of 1990s, there was a sudden surge of demand from emerging countries. So the sharp reverse of supply and demand balance of commodities caused the sharp increase of commodity price, and also the capital inflow into commodity market starting from 1999 and afterwards, for a few years afterwards. So that's why Australia was so lucky to have this resource boom, right? So with this large amount of money into commodities, actually, there was no enough capacity to absorb this amount of influx of capital. So according to this research piece, at the end of 2015, the total market value of commodities, so that means that they estimate the value of all of the existing commodities, the gold bars, the oil, the barrels of oil, they put them together. It's estimated to be $0.24 trillion. And at that time, it's even less than the market value of Facebook. So in other words, the total market value of all of the commodities around the world was actually less than one of the largest companies in the world. But at the same time, the money invested, so-called invested in commodity markets, so that will be calculated as the total value of open interest of the futures contract market, is estimated to be $2.3 billion. Trillion dollars, sorry. That's 10 times of more capital invested than the total value of physical commodities. So with this large amount of money invested in the commodity, is the market still in normal backwardation? It probably will be less likely the market is going to be in normal backwardation, or in other words, the commodity market may be not driven, not dominated by hedges anymore, but it's going to be dominated by speculators. For producers and users of commodities, do they really have to offer a nice risk premium in the market anymore to have counterparts in the futures contract? No. If there are more and more speculators in the market, even though the supply exceeds the demand of oil, the oil producers do not need to offer a large size of risk premium anymore. So you probably will observe a smaller difference between the futures contract and the future expected spot price of oil. So with a lot of speculators, so-called investors in commodity market, the oil producers, they do not need to offer a large discount anymore, or not offering any discount anymore, or risk premium. So that's why the solid line indicates the risk premium of commodity investors in the past several decades of time. So obviously, after 2005, especially the global financial crisis, things have changed completely, and the risk premium has been negative. That's the impact from financialization of commodity market. A lot of speculators are in the market, and the producers and users of commodities, they do not need to offer a large or even any risk premium to have counterparts of the futures contract anymore. So that's not difficult to understand that the excess return investors expect to generate from holding commodity futures contract going to be eroded in the recent years. Forget to mention this. So that's another piece by the same authors in Financial Analyst Journal. And they study the 10-year, that's the long-term investment horizon of total return of gold, have looked at its correlation with inflation. No significant correlation is found with the 10-year return of gold and inflation at all. So hopefully I give you the well-rounded understanding of using commodity or gold in the total portfolio context as the inflation hedge. Actually, they are not good inflation hedge, and particularly for Australian investors, they're going to increase the total portfolio, very likely to increase the total portfolio risk. Other aspects of commodity investing is actually when you invest in different commodity index, no matter it's Goldman Sachs or Bloomberg, they are investable commodity index. You actually have different exposures of different commodity contracts. So depending on your need, you got to choose your commodity exposure. Still, the evidence I have presented over this class to show you that probably commodity investment is not an appropriate asset class for every investor. there are some investors, especially institutional investors, they are very good at forecasting commodity prices. And they might generate excess return from investing in the collateralized commodity futures market, and they have their own expertise. But their expertise might be beyond the access of ordinary investors. There might be some opportunities of generating positive alpha. The collateral. If some investor who want to take the challenge, take the risk of investing in collateralized commodity futures contracts, you got to be very careful with this investment, because when you put your collateral there, depending on the requirement of the clearing house or the broker, the collateral can be as low as 10% of the total value of your futures contract upfront. Sometimes it might be up to 50 or 60%. So that can be a huge amount of capital commitment. And when there are unexpected changes in the futures contract price, you might get margin calls from the clearing house. So you have to, if you make lots in your account, you have to make up the margin requirement. And this graph shows you the commodity index performance. That's in $80 and in US dollar. Obviously, for Australian investors, the experience is going to be different from the experience of US investors who have the same exposure to commodity index. Depending on your objective and your risk preference. If I have an Australian investor who doesn't mind the additional risk of investing in commodities, is it a good investment? If I holding a total portfolio of 70-30% as allocation, $8 portfolio, if I still decide to invest in gold commodity index, what's the most likely impact on my total portfolio in the next few years? I'm going to have increased probably total portfolio risk. If I'm really good forecasting commodity price, I might have higher total portfolio returns. If the increased level of total portfolio risk is acceptable, that might be a good resource of excess return for some investors. The capacity of commodities is clearly laid out in this table. So that's total value of how much the commodities, how much the physical commodities are worth, the market value, and the sharp contrast with how much money are chasing that amount of commodity. So obviously there's excess capacity. Most investors who do not have superior skills or expertise in forecasting commodity prices, you should stay away from commodity investment, especially ordinary Australian investors. That will increase your total portfolio risk. Okay, so finally, I would like to talk about the readings. There are a lot of readings, and some of them are quite complicated and quite long. And I don't want you to go into much details of these readings, especially with hedge funds, private equity, or commodities. Just focus on the general concept. If in the final exam I give you something like this, and for Australian investors, I would like you to give an advice for a particular investor. You understand what you can extract from that exercise, from the numbers, and accordingly advise your clients, given the objectives and risk constraints. So don't worry too much about the details, especially the formulas, the calculations. Just remember the financialization of commodity markets has eroded the excess return for commodity speculators or investors. And going forward, that's probably will be the case. So I should hurry up and finish the workshop. So next, I'm going to talk about some topics that's to help you to approach the your assignment. Several groups have came to me to show me the quantitative models, which are relatively in good shape. So basically, you do understand that you should not minimize the portfolio variance, and you should not maximize the Sharpe ratio of the portfolio, and you should maximize portfolio return. So, and also I can see that some groups are very clear that all of the portfolio return and risk measures should be calculated based on 3-year performance. So that's how the portfolio is going to be measured. So these are good signs, and I do see you generate reasonable asset allocation so far. With this quantitative analysis, I gave you a lot of examples last week and tutorial as well. So if you are able to use these examples to apply to the case in the assignment, and with some judgments, so-called arbitrary or ad hoc subjective judgment with the asset allocation, you discuss why you have this asset allocation like this to help your client to achieve their objectives, you will be okay in the assignment. At least if you do not make substantial mistake, like minimizing the portfolio variance, you're going to have at least 60% in the assignment, at least for the analysis methods part. Depending, the final grade also depends on how well you're going to write your report. So this week, I'm going to focus on the qualitative analysis. They are probably not really guided in some way in any literature or any textbook, especially with the subjective complements to the quantitative models. We don't really have like a structure or some guidelines or standards you have to follow. So it's arbitrary in nature and ad hoc in nature, depends on your instinct and your belief that how you may improve the investor's portfolio marginally. So that's what we're going to do in this workshop. And if we have time, we're going to talk about some questions I received in the past 1 or 2 weeks. So first, I give you a list of resources. If you have certain problems or questions or doubts, you may go there to find the references. For example, how can I adjust historical returns? How can I do portfolio tilting? How can I do marginal adjustment of the portfolio weights? How can you run Bootstrap? So you can find resources from there. You probably don't want to read this. These just notes for myself. So I'm going to talk about firstly the qualitative judgment following a quantitative analysis. So we basically may run a bootstrap analysis, and we may run a hypothetical portfolio performance analysis, either using the mean variance optimization process or a manual iteration of the weights to generate the optimal asset weights. So these are just outputs from quantitative models. Obviously, solver doesn't understand the life stage of your client. Solver doesn't understand the unquantifiable risks or concerns of your clients. For instance, the concern of inflation. So these will involve your subjective judgment, and you got to fine-tune your asset allocation in a way to help your client to have a better chance to achieve their objectives given the constraints. So this is very much case-by-case analysis depending on your quantitative portfolio output. You might start by examining the portfolio expected returns and risk measures. If all of the return target and risk measures are satisfied, you still need to consider the unquantifiable concerns of the investor, for instance, inflation. See if you have inflation-linked bonds in your total portfolio, or if you have any other assets that will provide a good inflation hedge in your total portfolio. And if there are already inflation-linked bonds or direct property, for instance, that provides a good inflation hedge, next thing is go to marginally change the weights manually. See if you can improve the portfolio return and risk measures marginally so that you can settle on a more optimal asset allocation. So depending on your own beliefs, your own assessment of the necessary judgment, finally, you may settle on the optimal asset allocation. The portfolio outcome might be lower than the portfolio outcome from the quantitative model. But this set of optimal portfolios should be recommended to your clients because it incorporates all of the risk measures and concerns of your clients. And there will be a high chance for your client to achieve their objectives given the constraints and concerns in their circumstances. So this process is manual and depends on your own belief and how much testing, how new ideas you want to introduce in your total portfolio recommendation. So if you do include a quantitative analysis method and a reasonable analysis of the qualitative judgment and adjustment, fine-tune of the assets, your overall portfolio construction advice is in a reasonable format. Next, I'd like to talk about the formal application of a qualitative asset allocation approach. One is that it's called a qualitative asset allocation approach. It means that it's a structured, well-structured process. So you understand the different steps and elements of that analysis process, and finally, you can produce an asset allocation and portfolio measures that you can prove that this analysis approach can generate asset allocation that will help investor to achieve their objectives given their constraints. So one is called an approach. It's well-structured process with clearly identifiable elements and steps and careful implementation of these steps and process. So it's really different from ad hoc, arbitrary, subjective or qualitative judgment. So with the qualitative analysis approach, we have the choice of fundamental risk approach. That's a purely qualitative, and you might start from the existing portfolio. That's 60% in direct property, 30% in Australian equity, and 10% in fixed income. So you might start from there, identify the fundamental risk factors, and then propose asset swaps to diversify these fundamental risk factors. And then with this recommendation, you plug this weighting back into one of your quantitative models to generate portfolio measures. So that's when you apply fundamental risk approach. Another choice of qualitative or hybrid of qualitative approach, asset allocation approach, is two-stage approach. So with the two-stage approach, there's formal application of two-stage approach. You got to firstly lay out your context of your analysis. So you have to read the details of the articles to have this understanding what you should do. So first, it's not first stage. Firstly, you should need to have a general understanding of the economic development, economic forecast, interest rate, asset returns, and you understand the assets classes within the consideration, and you have a good understanding of the investor's circumstances, objectives, investment horizons, and all of the risk considerations. So that's actually the first step of a two-stage approach. Then it comes the first stage. With the first stage, we do run mean variance optimization, but we only include asset classes that we have confidence in forecasting, or we have confidence in the historical returns. So you're going to run a baseline portfolio with limited asset classes. For instance, Australian equity, world equity, maybe direct property, and Australian and world fixed income. So that's your baseline portfolio. With these asset classes, you have confidence in the historical returns, and you have confidence in forecasting the expected returns of these assets. So you run mean variance optimization with this restrictive set of assets. That's the first stage. In the second stage, you have much space to be adventurous. You have much space to be creative. So test your ideas. Given you may follow the example from tutorials of doing tilting of portfolios, doing introducing new assets financed with existing assets within the portfolio, for instance. So you may test your ideas of introducing new assets into your portfolio, your baseline portfolio, for example, emerging equities, commodities. If you want to, you can introduce gold as well. And what about other assets? Infrastructure, for instance. A group did ask for the data of listed infrastructure. So test your ideas in the second stage of the two-stage approach, and this can be a very vigorous analysis process. It might involve quantitative research, qualitative research, quantitative analysis as well. So that's your second stage. And then finally, after the first and second stage of analysis, you can settle onto the optimal asset allocation. And lastly, don't forget the implementation issues. So the implementation issues may include if you advise selling all of direct property for your client, how much tax they have to pay. Is that acceptable? And if you advise investing 5% of the total portfolio in hedge funds or private equity, is that possible? What's the total value of the portfolio? It's not $1 billion. So 5% of asset allocation into hedge funds or into private equity funds might be not a huge amount of money that you have access to any PE or hedge fund managers at all. So all of these are implementation issues before you can make your final recommendation of asset allocation. Hopefully, I have made myself clear about applying the qualitative judgment or a formal application of qualitative asset allocation approach. So I do give you a quite detailed notes over here. Lastly, we still have time. For some students, if you have the ability, because from the starting of the semester, I have asked you to build up your understanding of the monetary policy, the financial market gradually over the semester. And you should, if you have followed my instruction, so far you should have a good understanding of Australian economy, at least some understanding of the US economy and the uncertainties we are facing right now. So you might want to run some additional research or analysis on particular asset or asset class and condition your asset allocation advice on this additional research or analysis. I'll give you an example of Australian housing market now. If you don't feel confident of running any additional analysis, you are still okay for the assignment. You will get additional marks by running this additional analysis, but you won't be penalized by not doing this. So I'm always thinking about ways of making this course useful So it's not going to be tested in any way in the exam, or not going to be, you're not going to be penalized if you don't do this in the assignment, but hopefully I provide you some guidance for your future development and give you some understanding of how can this be done in a professional way in the industry. Okay, so we'll start from the investor's existing portfolio. We're going to have analysis of the residential property market in Australia, and then we're going to use that to form our advice on selling or holding on to that properties without considering other diversification problem or other objective or constraints. So here we have a well-defined topic or theme, but probably how much you might apply this to the client is going to be dependent on your own ability and your own willingness to run additional analysis. So I have this client who has 60% of the portfolio in Australian housing market. So they are for a few investment properties, and 30% in Australian equity and 10% in Australian fixed income. So that's my client. There will be less constraints than in the client in your assignment. So my client question is only to ask me, shall I hold on to my investment property portfolio, or I should sell it right now before the possible hard landing of the housing market or further slump of the housing market? So we're going to do some analysis. It's actually not numerical, but intuitive analysis to answer these clients' concerns or questions following this line. So now we have a problem of forecasting the performance or the value of Australian housing market. That's what we are going to produce. How can I understand the value of Australian houses? We still go down to the bottom. How can I decide the value of Australian houses? We don't just go randomly grab something in the air like interest rate, or the Banking Royal Commission or whatsoever. We don't go there randomly, grab something. We got to structure our analysis. What determines the value of Australian houses? Yes, supply and demand. So now we have supply, demand of Australian houses, and the relative balance of supply and demand will determine the value of Australian houses, at least in the near foreseeable future. So from the supply side, how can I assess the supply of Australian houses in the medium to long term, like in 3 to 5 years? How can I decide the supply? Upfront, what can we get about the supply of Australian houses? Do we go there to count the number of houses, the number of apartments? Yes, we do. We try to estimate the number of houses, the number of apartments. That's how you decide part of the supply puzzle. So we're going to try to count the number of existing houses and existing apartments. Where do you get the data? Where do you get the data? Anyone? At least you should know that if you are following the Australian economy, what's the government agency releasing the inflation and GDP rate? Australian Bureau of Statistics, they have consensus data. That consensus data comes in waves, but they do have data in the existing stock of Australian houses. Semi-detached houses, freestanding houses, apartments. Is that all? That's the supply, the full story of supply of Australian housing market in the next 5 years? What's the other part of the puzzle? We can easily find that number of existing houses and apartments. What's the other piece of puzzle to understand the supply of houses in the next 5 years? Construction, yes. So from ABS, you will have access to the time series data of building approvals. What's building approval? So before you build a house, build any apartments, you got to have the approval from councils. So ABS, they collect the data from councils to estimate a number of how many houses, freestanding, semi-detached, townhouses and apartments have been approved to build in this quarter. Is there anything that you can improve our estimate of the supply? So obviously, the supply is driven by demand, household demand, and what's the other side of the supply side? That probably you have mentioned part of that story, construction. Do we have the building materials, labor, the resources to build these approved houses? So on the supply side, we're going to collect these data for the next 5 years. What other factors will come into play to determine the supply of houses? If you want to build a house, you need to get approval from councils. And for certain streets, you are allowed to build low-density houses only. For some other streets, you might build high-density accommodations, for instance, apartment buildings. So the supply of houses is also determined by the changes in zoning regulations. Zoning and approval. With these regulations, forecast changes, you might find data from government agencies. Like Treasury, they have forecasts. They managing Australia money, and they do have forecast of like the population, the housing demand, and of course, they are related. As most of the economic indicators, they are correlated. So all of these factors will determine the supply of houses in the Australian market. From demand, what do we know that what will determine the demand of houses? Population, yes. So that's going to be population. Is that enough? we have 25 million people. Do we need 25 million houses? Yes, household, not just population. We need household. We need an estimate of households. So if you go to ABS, you're going to have the very concise number of households. And if you have a search of government agencies, you're going to have population and households forecast as well. So now we have population forecast, households forecast. We probably have a better understanding of how many families are going to need a house or an apartment in the future. With the demand of houses, any other factors? Migration, that's part of the population puzzle. Other factors when a family decides to buy a house. Income is actually wages of Australian households. If you have a look at the detailed data of Australian households in the past several decades, we are having smaller families and more single-parent families and more individual households. That's the demographic changes in Australia, of course, aging population. What else? What else? Is the interest rate important? What do you think? How important is interest rate? We are at historical low interest rate. Sorry, I can't hear anything. The mortgage rate? Yeah, it's still very low level now. What's the latest monetary policy decision from RBA? No change. Yes, no change. They keep the interest rate, target interest rate on hold. But given the recent uncertainties in the market, and in the past few days, we have this stock market came down a little bit, which I think is overdue. This should have happened quite long ago. So how can we interpret the interest rate on hold decision from RBA? Do they believe Australian housing market is a substantial risk for Australian economy? The Australian housing market is experiencing a healthy correction. At least it doesn't look like a hard landing or crash. No, it's a healthy correction. It's not like what happened in the global or after global financial crisis in the US property market, that millions of families will actually have to face the problem of negative equity in their mortgage account. So negative equity means that the house value has dropped below the value of their mortgage. If they, I'm going to move out of the house and foreclosure, I give up the house, just let the bank take my house, you still owe the bank money. It's not the case in Australia. From RBA, you have these time series data of the household indebtedness, and you have some other gauges of the value to mortgage ratio to assess the condition of Australian households, their mortgage conditions. And some other measures, for example, the mortgage real rate, so the proportion of home loan owners who are at rear of their mortgage repayment. There are some hotspots on this, especially in Western Australia, but generally the market is fine. So from there, we can probably interpret the on-hold decision from RBA as they are not too worried about the change movement in the housing market. That's actually is only part of the Australian economy. They are only worried about when there's significant wealth effects that will affect consumption. So if we do have negative equity in their mortgage with their house, consumers are going to stop spending money. That will be a real problem for the economy. And another consideration that we might infer from the decision of RBA is that they probably are not too much worried about the low inflation. Right now, the last quarter inflation is about 1.3%, which is very low, very much below the inflation target. But RBA has decided to keep the interest rate on hold instead of stimulating economy, trying to improve the inflation rate, which means they probably are not too much worried about the inflation for the last quarter, and they would like to wait and see for another quarter. And also, of course, from the labor market statistics, it's still okay. So that probably what you can infer from the latest monetary policy decision of RBA. They believe Australian economy is okay. There's no significant risk. Even if there are uncertainties, they would like to wait and see. Are there other drivers of demand? Yes, that's very important. And I wonder, why didn't you say it in the first place? So price obviously has come down in the major cities, especially Sydney and Melbourne. And what's that impact for households' demand? A lot of first home owners, especially the younger generation, after Z, we run out of the numbers after X, Y, and Z. How can we say the other generations? So they are practically locked out of property market without the help from their parents before the recent fall of house prices. So right now, we probably will see in the next few quarters, we're going to see more first home buyers or younger people to come into the housing market. That probably is something positive. So these are the general directions where you might find the drivers of supply and demand. And there are a lot of details. You decide how much details you're going to apply in your analysis. For instance, with the household and population forecast, as I mentioned, there's a trend, demographic change in Australian households, that smaller families, smaller households, and allowed more single-parent households and individual households. So going forward, we're going to need less large houses. We're going to need more smaller-sized houses, might be apartments. So all of these can come into your understanding of the relative supply and demand. So if we have the good understanding of supply and demand, we can calculate the actual number of the forecasted houses built in the next 5 years and the forecasted households who are going to buy the ownership of houses in the next 5 years. We're going to have some rough estimate of the relative balance of supply and demand. If we do find that supply is going to 10% higher than demand, how are you going to build this into your forecast of house price in the next 5 years? Do you have any ideas? So at least we can foresee if there's an oversupply, we might see